What's up, YouTube? So, for those of you guys who don't know, I was able to become a millionaire by all-inning on Tesla back in the 2019-2020 time period before the stock 20x'd. And that completely changed my life from, saving, tens of thousands of dollars over like 7 years to all of a sudden, becoming a millionaire in just a couple years after I started investing. And after that, since that moment, I am now all in two companies. And I mean, that's mostly true. I actually also own a little bit of a third and fourth company, but almost all of my net worth is 50-50 in two companies. And it's an interesting period because, I don't really have any of these like strict frameworks about how I have to invest my money, like, it needs to be in this sort of stock and that sort of stock, and there's all these diversification requirements. No, I more follow what Warren Buffett said about put the majority of your money in your very best ideas. And I'm someone who obsessively is researching stocks. So after, going through hundreds and hundreds of ideas, I feel like my best are actually like really great asymmetrical opportunities, which means they have a lot of upside, but they're so attractively priced that they don't really have that much downside. And I don't even know if there will always be this sort of opportunity in the market, but at this moment in time today, the public market seems to not be able to very accurately price pre-profit growth companies and has an idea that they are so much more risky than they actually are. And I realized this with Tesla. As soon as they flip to profitability, there is a huge repricing that happens because most of the risk gets priced out. So both of the companies that I'm all in now are just either flipping to GAAP profitability with UiPath, or they are like within 12 months of flipping profitable with Lemonade. So I know that these are going to be very big upside catalysts ahead. They're also fundamentally cheap, and we're at this very weird moment where I am about 50-50 in Lemonade and UiPath. And UiPath has been going up a lot the last few days. We'll see how many days it takes for me to post this, but maybe it's pulled back a little bit, but it also could be a lot higher because it's so cheap. But we're at this crazy moment where UiPath is actually a little bit over 50% of my portfolio now, when I have been all in on Lemonade, for so long. But both companies now are just as attractively valued. So the metric that I like, and by the way, I'm just going to be walking through this kind of property that I'm staying at right now. I don't own it. I'm Airbnb-ing it as I'm talking. But when I go over this edge here, it's actually going to be super windy, so it's perhaps not a good idea. So I'll finish this and then I'll give you a tour. My favorite metric is enterprise value, which is like the actual value of the company. It's taking market cap, it's adding debt, and then minusing cash and actual assets. So it's getting the real price that you're paying for a company. Because you can think about it this way: like if you were buying a house for $400,000, but that house had $100,000 of cash inside, you're really buying the house for $300,000, right? Because as soon as you own it, you go inside, you have the $100,000 of cash, so you're only, net paying $300,000. That's essentially what getting enterprise value is doing, because a lot of companies have a ton of cash, and the great ones also have no debt, like the ones that I am invested in that actually have a chance of, bankrupting the company. So I do enterprise value multiplied by look-through earnings. So this is my favorite metric, and it allows me to run some of the calculations that Peter Lynch, my mentor, did, where he was trying to find companies with a price to earnings below the sustainable revenue growth rate. You can't really do that in the market today. It's a lot harder. But with look-through earnings for pre-profit companies, oh my gosh, there's so many of them. And so essentially what you're doing is just saying, okay, when this business is mature, after it reaches maturity, what is its mature margin likely to be? And you don't go crazy with this. You look at the actual reasonable net margin. You can look at competitors. You can look at this company's advantages, this company's gross margins, and you can get an idea what the long-term net margin is likely to be, with a good amount of reasonability. And you apply that long-term expected profit margin on today's revenue, on the trailing 12-month revenue, and you get what the look-through earnings would be. So pretty much you're asking yourself, if this business was mature, how much would I be paying for it? And what's crazy is you get these crazy growth valuations doing that for these super fast growing companies. So it's like this crazy opportunity where the companies are actually not expensive at all and they have crazy growth rates. So like for Lemonade, its look through EV to earnings is 15. For Path, it's 15. So their look through enterprise value their enterprise value to look through earnings are about 15, which is like super great price for Lemonade growing 30% a year. Its revenue is about to be almost 100% growth the next 12 months. And UiPath, which has just gotten into revenue growth acceleration. It was having a hard moment before it figured out where its place in the AI ecosystem was going to be, but now it's figured that out, and it's gone from 5% revenue growth to 11% growth in ARR, and I think 14% overall revenue growth this last quarter. And I think that this acceleration is going to continue, and we could possibly see UiPath. It's not as certain earnings as or certain revenue growth as Lemonade, but we could see UiPath far more probably go to like a 80% revenue growth rate or something like that because of the potential of orchestration of the AI revolution. But okay, let me give you a tour of this property that I'm at now. By the way, you can see this beautiful view that I'm looking at down here. It's going to be really windy, so you're not going to be able to hear for a second.
While I was walking, it was pretty windy and you couldn't hear me, and I was doing this weird breathing, so I'm just going to do a voiceover. And while I'm walking to the next spot that I'm going to talk at, I want to tell you about 5 books that I recommend learning if you are reading it or listening to if you want to learn how to invest. So the first one is just like to help build your mindset and get your overall strategy for becoming wealthy, and that is The Richest Man in Babylon, and we'll link these in the description. Number 2, the second book after you read Richest Man in Babylon that I think is great is Americana, 400 years of American capitalism. And that book is just super great for understanding your place in history and just really getting it in your brain how quickly things in the world can change. They can change so fast, and it's going to allow you to bet on new innovation and believe that it can be big. If you see the same signs of previous innovations that have completely changed the world, the way that the world works. So rapid fire these last 3. Obviously, Peter Lynch, One Up on Wall Street, after you read Americana. And then I recommend reading Philip Fisher, Common Stocks and Uncommon Profits. And then finally, read and listen to everything that Warren Buffett has said.
Okay, so we're now at the pool kind of living area here. The hammock, pool, it's really cool. There's like a whole separate living area at the end underneath those tables as well that has its own like lookout to the ocean too. And then there's like more bunks you can see. Well, not bunks, like whole like individual cabins. Some of them have full kitchenettes for my family. So yeah, it's me and my family out here. And yeah, it even has its own, private bar here. Haven't really figured out how to use money yet, or I'd have a bartender and a chef and stuff going on. But yeah, it's actually like, I know this looks crazy and it seems crazy, but if you can delay gratification for a certain period of time so that you can pay yourself some of your earnings and let your earnings start working for you, and you don't eat the crumbs immediately, like the babies that your money is having immediately, you let it compound, then eventually you get to a point where this isn't like crazy decadence for me or something. Like this is spending a very, very, very small fraction of the amount that I am earning, to the point where I can continue to compound and continue to grow. I would never actually put that at risk. but you have to be patient, and you have to delay gratification, and you have to, not spend on a lot of those things, so that eventually, you live like no one else, so that eventually you can live like no one else. And I was never like into like the FIRE movement or something, but like kind of, you have to have more income than expenses. It doesn't matter what your income is. You just have to have more income than expenses, so that you can be investing part of your income every single month and watch it start compounding. And like, you can reach financial freedom just putting it in the S&P 500. You don't have to be a great stock picker. Like, the average in this game is getting like an 8% annual return. That's why it's such a great game to be in. The average is getting an 8% annual return. So you compound for 15 years, and you're going to be so surprised where you are, especially in the age of AI, where the companies I'm investing in are literally automating mundane tasks and are going to be able to increase the efficiency and the profitability of all of American companies so crazy amount. Like, this is perhaps one of the best times, I think, to be an investor in history, and we're going to see some of the craziest growth in earnings, I think, in history because of AI. So like, don't wait, start investing. And there's my little update from me. I am so grateful, by the way, just for like the incredible shoulders of giants I've been able to stand on in the investing space. Like, I literally treat One Up on Wall Street by Peter Lynch a little bit like my investing Bible, except for one thing. I steal from Warren Buffett, which is concentrating in your best ideas. And Peter Lynch, who wrote One Up on Wall Street, he had the incredible 29% annualized returns, which destroyed the market, which is why I wanted to learn from him. He owned thousands of stocks, and I think he would have done even better if he was a little bit more disciplined and concentrated in his investments, like Warren Buffett and Charlie Munger talk about, where you don't have to swing at all of these like risky things. Like, you can literally research an infinite number of stocks, and it's good to research as many as you can, but you don't have to invest in most of them. Like, you can just invest in your few very best ideas. So like, I know 20, 30 investable stocks that are kind of interesting, and I could have them all in my portfolio, but I don't. Literally the majority of my wealth, the majority of my resources are invested in Lemonade and UiPath, and that's it. And they both make up almost 50% of my, total portfolio value. So, you have to invest off of your own conviction, though. You can't invest off of someone else's. Oh, and also, the last thing I want to say before I close out here is just that I am so grateful for my family being a part of this channel as well, and Aaron making so many great videos. I hope you guys are enjoying that. And also, we don't ever actually want to charge for anything. We've been thinking about this. The one argument for having like a paid anything is so that you can provide even more value. That would be the only argument if like there's something crazy valuable, but we can give most of the valuable stuff for free. And I actually think, we can give all the valuable stuff for free. And I think maybe the way to make the most in this life is to only give for free. And I was like, well, what's the end game of that? And it would be like literally launching a holding company like Berkshire Hathaway, and just having all of my personal wealth invested in it, and then just letting everyone, buy or sell into my investment portfolio, which would be the public holding company. Like, and that would, like, never charge money for anything, and just provide another asset out there that people can make money off of. I feel like that would be a pretty cool end game for only giving stuff away for free and never charging anyone for any of it. But if you did enjoy this video and you like this update and you want more updates like this, I guess drop a thumbs up, and subscribe to How to Invest, and watch more great videos from Aaron, my brother, and Abigail, my sister, and more videos from me as well, as I just continually research more stocks, learn more, and man, I just absolutely love diving into this, which is why I know I'm going to be doing this long term. So thanks for watching, everyone, and don't be intimidated or overwhelmed when you're getting into investing. There's going to be a lot that can scare you, but trust me, it's like the acronyms and stuff, look them up. You can figure all of this out. You really only need like a 4th grade math take control of your own future, take control of your own destiny. Bye.